In this video, I'd like to have a look at capital gains tax for individuals and the basic calculation and framework. Before we have a look at capital gains tax though, let's just remind you where it fits into the framework of taxable income. So in taxable income, we start off with gross income. This includes the general definition of gross income as well as specific inclusions. To this, we add any deemed inclusions, which are our Section 7 deeming provisions. And from that, we less any exempt income. So in terms of Section 10 or Section 10A, amounts that are not included or have to be exempted from gross income. Then we total that up and it gives us our first subtotal, which the Act refers to as income, a defined subtotal. So income means gross income less exempt income. From that, we can less any allowable deductions except for Section 11F and 18A deductions, which is our retirement fund and donations to public benefit organizations. And then we total our taxable income calculation again. After that, we can deduct any assessed loss carried forward from the previous year of assessment, and then we need to re-subtotal. To that, we will add the taxable capital gain, add any other amounts included in taxable income, like the unexpended portion of the travel allowance or subsistence allowances. Total our taxable income again, and then we less retirement fund contributions. Remember, there's a percentage that's based on that total just before retirement fund contributions. Total our taxable income again, less donations, and remember there's a limit that's limited to 10% of the taxable income before donations. That's why you need a total before that, and that then gives us taxable income. So in this video, we're going to have a look at how do we calculate the taxable capital gain that's included in the taxable income calculation. Well, first of all, you need to remember that for capital gain, we must calculate it on the disposal of each and every asset separately. So you can't add all the proceeds together and less all the base costs. Each asset must be done separately. We get the proceeds of each asset, less its base cost, less any specific exclusion applicable to that asset, and that gives us the capital gain or loss for the specific asset. Once we have the gain or loss for each of the assets, we add them together, and then we can deduct the annual exclusion, which currently is 40,000 Rand, and that gives us an aggregate capital gain. If the individual had a loss in the previous year of assessment, you can then deduct that capital loss, and that gives the net capital gain. If it's a gain, it gets multiplied by 40% and included in taxable income. If it's a loss, it gets carried over to the following year of assessment. Right, so what is proceeds? Well, for non-depreciable assets, it's a non-adjusted full amount of the sale price of the asset. And what often happens with residential property is that the net proceeds the gross proceeds has agent's commission deducted from it before it gets paid to the individual who sold the house, because agents get paid in terms of a percentage of the sale price of the house. So for example, I just want to go through an example with you so that you understand when you're working through a question. In this example, the taxpayer received an amount of 1.410 million after 6% agent's commission. Well, that means we've got to include the gross proceeds in the capital gains tax calculation, but this is referring to the net proceeds because agent's commission's already been taken off. Okay, so let's have a look. The net proceeds represents 94%, which is 1.410 million Rand. Now, that's 94% because we told in the question that the agent's commission is 6%. So 100% minus 6% gives us 94%. The question gave us the 6% commission. So we need to work out the gross proceeds that we're going to include as proceeds for the capital gains tax calculation. So we divide the 1,410 divided by 94%, which gives us gross proceeds of 1.5 million rand. And then to get to the commission, you say the 1.5 million less the 1.410 gives us 90,000 rand, and that will be included in base cost. So that's what often happens with the information given to you on residential accommodation or primary residence, and you need to work backwards to the gross proceeds. So let's have a look at how we would calculate the base cost. Now the base cost depends on when the asset was purchased. If it was purchased before the 1st of October 2001, when capital gains tax came into being, or if it was purchased after the 1st of October 2001. So you always need to look at the date the asset was purchased. If it was purchased before, then we exclude, I'll show you in a diagram now, we exclude everything before the 1st of October, and we have to calculate a valuation date value, which is the value of the asset on the 1st of October. And then to that we add any qualifying expenses that were incurred by the taxpayer after the 1st of October 2001. We'll have a look just now at what qualifying expenses are. If the asset was purchased after 1 October 2001, then we can take the cost of the asset plus any qualifying expenses that were incurred. So let's have a look on a timeline. Capital gains tax came into being on the 1st of October 2001, and we are now in 2020. So any costs or expenses incurred of purchasing the asset during this time is included in the base cost of an asset for capital gains tax. If an asset's purchased before 1 October 2001, then those costs are going to be excluded, but we're going to calculate a valuation date value of the asset on the 1st of October 2001. To do this, we're going to use either paragraph 26 or 27 of the 8th schedule. 26 is when we're in a profit situation. We're going to have a look at that now. And there, the valuation date value will either be the market value of the asset, which you will be given, the time apportionment base cost, which you'll also be given, or the 20% rule, where you can work out 20% times the proceeds minus the expenses incurred after the 1st of October 2001. Now, if we look at actual expenses incurred in terms of these dates, any expenses actually incurred before the 1st of October 2001 are disallowed. They have no impact on the asset, because remember, that's before capital gains tax came into effect, and we're going to work out a valuation date value in terms of what the Act allows us to. Expenses after 1 October 2001, remember, repairs are not a capital expense. They to keep the asset running, so they're not allowed to be added to the base cost, but any improvements to the asset are allowed to be added. And all these qualifying improvements or expenses in relation to improvements are added to the base cost. So the proceeds are kept as gross proceeds, the amount you receive for selling the asset, less any expense. Right, so let's have a look at how we would calculate the base cost for an asset purchased before 1 October 2001. We're going to look at a paragraph 26 situation, and that just means that we're sitting in a situation where there's a profit on the sale. In other words, the proceeds exceed the expenses that were incurred before and after the valuation date. And the valuation date just refers to the 1st of October 2001. So our valuation date value of that asset will be the highest of the time apportioned base cost, which you'll be given, the market value of that asset, which you'll also be given, or using the 20% rule. You'll take the highest of those three to use as the valuation date value of the asset. There is one exception, however. If the market value exceeds the proceeds, then your valuation date value, you won't use the highest of those three. You will go straight and use proceeds minus any expenditure after the valuation date. And that's just a limitation of last rule, so that losses can't be created through the manipulation of market value. Okay, so if an asset's purchased after 1 October 2001, then we're going to use the actual expenses incurred, because now when the person bought the asset, they knew that capital gains tax existed and they were required to keep proof of all the expenses. So the base cost after 1 October will include the cost of the asset, the cost of acquiring or disposing of the asset, and that'll include expenses like advertising, legal fees, a valuation fee, and the agent's commission that we spoke about earlier. Then any improvements that are still reflected in the asset can be claimed, the cost of those improvements, as well as if you've had to defend a legal title of an asset, you'll be able to claim those costs as part of the base cost when you sell the asset. Okay, so let's get back to where we were. Proceeds we've discussed, it's the gross proceeds less the base cost. That's dependent on whether the asset was purchased before or after 1 October 2001. And then we need to have a look at any specific exclusions for each asset before we move on to the next asset. So what you're going to get quite a lot with individuals is a primary residence exclusion, where 2 million rand is excluded. The first 2 million rand gain is excluded. However, you do need to apportion for months where the residence was not used as a primary residence or where it was used for business purposes. And also this exclusion of 2 million only applies to the first 2 hectares of land. So if it's farming land, only the 2 hectares around the farmhouse will qualify for a primary residence. The rest will be part of the trade. And then if the residence has more than one owner, then each owner is entitled to a proportion of the exclusion depending on the percentage that they own. And you also have to adjust the 2 million rand exclusion for the primary residence for periods of absence up to 2 years, where the Act deems the individual to have been ordinarily resident in their house. So let's say the house has stood empty and no one stayed in it for 4 months. Anything up to 2 years standing empty because of a sale will just be included in the primary residence exclusion. You won't have to do any adjustment for it. The same as if you are busy erecting a new residence and you're not staying in it, up to 2 years, it will still be counted as part of the primary residence. Where the residence is inhabitable, perhaps there's a fire and people can't live in it for 5 months, that will be ignored for the purposes of the exclusion. And then also where the individual dies. Anything up to 2 years. We'll work through an example so that you can see how this works. And then there's also periods of non-residence that will be deemed to be residential use. And one is a very specific situation where the taxpayer lets out the residence for 5 years, and it will be excluded from the calculation or deemed to be part of the residential use, but in very specific circumstances, where the person lives in the residence for at least 1 year before and 1 year after the 5-year period, and they have no other primary residence during that 5-year letting time, and they either temporarily absent from South Africa or they were employed more than 250 kilometers away from the residence. So this is looking at a very specific situation where the person's forced to go somewhere, probably for employment purposes. They let out their primary residence, they don't have another primary residence, and then it's deemed to be part of the residential use of the asset. So no apportionment of the 2 million rand needs to take place. There are other exclusions as well. Personal use assets, those are assets that are used mainly for purposes other than trade. You'll need to go through that list and know to identify those kind of assets straight away. And then also if a person sells the active assets of a small business, There's also specific requirements that you need to have a look at. Then the first 1.8 million rand of the gain is excluded for capital gains tax purposes. So let's have a look at where we are at for now. We've discussed how we calculate the capital gain for each asset. We've had a look at adding them together, the exclusions that could be available. After you've done that, you'll have to minus the annual exclusion of 40,000 Rand. See if there was any assessed loss brought forward from a previous year. That'll give you the net capital gain. Multiply that by 40% and it is included in your taxable income. And there's an example for you to try and work through on your own. Have a go at it, and in the next video that I record, we'll work through the answer together. But it's better for you to have a try on your own to see what you understand and what you don't understand, and then look at how we solve it in the next video on capital gains tax.